Hello, trader friends. There's something strange in the neighborhood. Who you gonna call? Uncle Tony. Not Ghostbusters, no. There's something very weird happening in this market. A lot of stuff is happening. The market's reacting the wrong way. Stocks are reacting the wrong way. And I'm gonna show you what's weird and how to play it. So stay tuned and let's get to it. The first thing I want to show you that was weird, it's not the face of the chairman of the Bank of Japan, Kazuo Ueda, but it's what Mr. Ueda did that scared the heck out of me. I know the picture's a little scary too, but the Bank of Japan ends 17 years, yes, 17 years of lowering interest rates, keeping interest rates negative, yes, negative. And they went from minus negative zero point 0.1 to a range of zero point 0.0 to zero point 0.1. Yes, what happened? Japan raised rates for the first time in 17 years. And what does this mean to you? Normally, we all know about the carry trade. You borrow in yen and then you invest in dollars or in other currencies where you can have an arbitrage, where you can make some interest. But if Japan starts raising interest rates, what does that mean for the world? It means that the carry trade is over. It means that risk is off. And stock markets should crash. The yen should strengthen, be very, very strong. And what happened? What happened? Completely the opposite. Let's take a look at the chart of the USD versus the JPY. Just as a reminder, trader friends, the first product that's on the left hand side, that means it's the one that the chart feels like it's bullish. So if it's going from the bottom to the further up and USD is on the left hand side, that means the US dollar is strengthening. Take a look at this. Take a look at this craziness. Ever since the Bank of Japan raised rates, the yen the yen should have strengthened. The yen should have been more powerful. The yen should have been incredibly strong. And what happened? What happened is the yen actually lost value. It devalued, which is completely insane. How can your currency devalue when you start raising interest rates? When you start raising interest rates, more people want to put money in your currency because you provide a higher interest rate. So this is the first weird thing that I noticed. Now, how are we going to play it? How are we going to make some money out of the Bank of Japan's first interest rate raise? Since derivatives are very hard to find, there's two ways to do this. One, you can sell the USD JPY directly on FX. That means you are selling dollars and buying yen, hoping that this craziness reverses. Or here we have a chart of the future, which is a very easy product to trade /6J. So what I would do if I think the market's reaction was wrong, I would just buy the /6J. Buy it outright. I don't want to use derivatives because derivatives are not very liquid here. They're not easy to trade. So if you think that the market reacted incorrectly to the Bank of Japan raising interest rates, what I would do is buy the 6J. So that's the trade for this first crazy thing in the neighborhood. The second scariest thing I've seen the last week was the Fed. Yes, Uncle Jerome Powell came out and it was a very, very weird speech. Why? Because he said he's going to cut interest rates three, not one, not two, not three times, which is still a lot. And why do I think it's still a lot? Because something happened weird in January and February in the United States. January and February, inflation went up, not down. So why, how are you going to cut interest rates when inflation is going up? Doesn't that throw fuel to the fire? It's like throwing air or gasoline to a fire. It's just going to ignite it. I don't understand what's going on here. I don't understand why the Fed insists on lowering the interest rates when inflation is going up. But I'll tell you why. I'll tell you why. The government owes so much money. The number one expense for the government right now is their interest payments. Yes. So, what is one way to lower the expense of the government? Is to lower how much they pay on interest on their debt. But this is really really weird. This doesn't make sense to me. So they're going to cut rates to lower the interest payments that the government has to make. And what's that going to do to inflation? It's just going to skyrocket, and it's going to just create more problems in the future. What we need is to have a good solid recession, clean everybody out, and have a reset. But no, everybody wants to kick the can down the road and postpone the problem. Let the other person deal with it. I'm telling you, this is weird, and I don't like this. But now let's take a look at how we should play this game. Here is the chart of the TLT. The TLT, as you guys know, represents the 20-year yielding treasury. And you know, when people start cutting interest rates, what should have been the logical reaction to the stock market? Let me make the chart bigger. The logical reaction should have been that the TLT should have shot up like a rocket. Why? Because interest rates are going down. And if interest rates are going down, TLT should be up, up. So why isn't TLT up? You know why? Because the market is smarter than the Fed. The market knows that if they start cutting interest rates, inflation is going to skyrocket, and inflation is going to skyrocket, then the TLT is going to have to go down. That's why it didn't go up. So I know it's weird. It doesn't make sense. So here's how I would play this craziness and this nonsense. Let's take a look at our beautiful Tasty Trade platform. And here we have TLT. You guys know it. I know it. We go 45 to 60 days out. That means May expiration. And here's what I would do. Here's how I would play it. If you think that the Fed is going to really cut interest rates and the yields are going to go down, then we should be bullish. And how can we be bullish? First of all, I would buy the 90 uh, TLT call for May, which is right here at the bottom of the expected move. And then I would sell something against it. Maybe the 97, maybe the 97 call for a debit of $3.87. And this is almost a risk one to make one because our maximum loss would be $387, which is the debit that we're going to pay, the 387, and our maximum profit would be $313. Now, this trade has a positive extrinsic value of $53. So remember, death before debit, which means death before extrinsic. So this is a very solid trade. Now, if you are more bullish and you really believe in Uncle Jerome, what you could do is just buy the 90 call outright, have a little bit of negative extrinsic value, which Uncle Tony doesn't like it, but you could still do it, and then hopefully the TLT starts shooting up, starts acting normal, and then you would profit from this. Now, if you don't believe Uncle Jerome, if you think that by cutting interest rates, the TLT is going to crash because the market's going to tell Uncle Jerome, hey, you're wrong. You're wrong. By cutting interest rates, you're going to have more inflation. Then you would do the opposite trade. I would probably, here we go. I would probably buy the 96 put over here and then sell the 91 put over here. And then another one, risk one to make one. This $5 wide vertical I would be paying $2.27 for a maximum loss of $227 and a maximum profit of $273. So there you have it. If you think the market's going to tell Uncle Jerome that he's wrong, you do the put spread. If you think if you believe Uncle Jerome and we never fight the Fed, you do the call spread. So those are two trades on how to trade this weird thing that's going on in the neighborhood. Now, this is one of the weirdest things I saw last week. And shout out to my buddy, my pal Sanjeev, Shark Jeev, who pointed out this observation to me. So the day the bad Apple news came out, Apple was down not one, not two, not three, not 4%. It was down 4% in one day. And what happened to the NASDAQ? The NASDAQ shot up to the sky. If Apple is one of the Mag 7, is one of the most seven important stocks on the NASDAQ, on planet Earth, everybody owns Apple. And Apple is down huge, and the NASDAQ goes up. Now that's something strange in the neighborhood. And how should we play it? We could play it one or of two ways. We either think that Apple uh, is going to keep going down, or that the NASDAQ that went up unexpectedly should come down. So let's take a look at the trades that Uncle Tony would do here. Now, Apple was down on an up day. And when a stock is down on an update, but wasn't down that much, maybe we have a short-term bottom in Apple. If that's the case, here is the trade that I would do. I would go to the beautiful Tasty Trade platform, and the easiest, the most simple trade is here. I would sell a naked put right at 170. The stock is trading right now at 172. I would sell the 170 put, and that requires some buying power, of course. It has a max loss of $16,000 in case Apple goes down the tube and goes bankrupt. It has a maximum profit of $485, probability of success of 65%. And, this is a very, very solid trade that I would do. Now, I know a lot of you are asking me, Tony, I don't have such a big account. I have a smaller account. How can I do some of your trades if I have a smaller account? So that's easy. Here we go. We verticalize that short put. And then here we go. By buying the 160 put, we reduce the margin to only $697. And our probability of success is reduced a little bit to 61%. And that's one way I would play Apple. Now, if you think the NASDAQ reacted incorrectly, which normally, the market never reacts incorrectly. If you think the NASDAQ is overextended, if you think the NASDAQ is in Looney Tune land, which it probably is, there's two ways to play it. Number one, you could sell the 450 call naked, but Uncle Tony. Uncle Tony's rules. Uncle Tony never sells a naked call. Why? Because the stock market always goes up, the stock market always bounces, and you always get hurt by selling naked calls. So what I would probably do here is sell the 450 call in the Nasdaq and buy the 455 call on the Nasdaq for a $2.46 credit. This gives you a 56% probability of profit. And if you think the Nasdaq reacted incorrectly to this market move, this is a trade you could do that won't break the bank. If you want to be more aggressive, you can move your long call to the 460. That way you collect more money, less units, more money, and then you would make a maximum profit of $453, and your probability of profit only moves to 58%. So if you think the NASDAQ reacted incorrectly to the Apple news, do the short call spread. If you think Apple reacted incorrectly to the NASDAQ up move, do the put or the put spread. So those are two really easy ways for you to play this craziness of the market we're living on. Now let's go to another fan favorite, Tesla. Mr. Elon Musk, the most influential entrepreneur of the last decade or 2 decades. Yes, he's a genius. You might like him, you might hate him, but Elon is a genius, and you never short a genius. But Tesla, since hitting peak in late 2020 of $400 and just recently hit a peak of $300, is now cut less than half. It's $170. And why? Because Tesla's prices are going down. Tesla is not being as popular as everybody thought in China. People are buying cars like BYD, who have a lot of technology, who are really cool, have a lot of features, and are cheaper than Tesla. And another bad news for everybody who's bought a Tesla in the last 2 or 3 years: used prices for Tesla are at an all-time low. When you buy a Tesla and you try to resell it, in the old days, you could get even more money than you paid. Now, you get less money. Why? Because car prices are going down. Tesla's been hit hard. Elon is cutting prices, and I'll tell you why. He's a smart fellow. Tesla is a very strong car company. And what happens when you start cutting prices? You squeeze the margins of your competitors. You squeeze the margins of Toyota, of General Motors, of Ford, of Hyundai, of everybody. And he's playing the long game. If you play the long game to win, by hurting your competitors, by making them lower their prices and making them less productive, what's probably going to happen? A lot of the competitors are maybe going to give up on EVs, and he's going to be the only player standing. So I think Elon is playing the long game by lowering prices. And of course, the stock is going to get hurt in the short term. So how would you play it? If you think the stock is going to keep going down, I'm going to show you a trade. And if you think that Tesla is going to hurt its competitors, it's going to keep gaining more and more market share, and more people are going to own Teslas, then you do the contrarian trade. But let's get to it and see what's going on. So if you think that Tesla, because it's lowering prices, it's lowering its own profit margins, it's going to get hit more, what I would do is, once again, let's do a short call spread where we sell the 180 call. Of course, once again, I would never short Tesla naked. Number one, I never short a superstar. I never gonna short Elon Musk in business. He is a superstar in business. Maybe you like him, you don't like him politically. I don't care. I don't know. Business wise, he is a superstar. And I would never sell a naked call in Tesla because I want to live another day. And you can do a 10 wide vertical. You collect a third of the width of the strikes, which is a very solid, tasty trade, a 66 probability of success. And if you think Tesla's going to keep getting hit with its margin, this is a very solid trade you could do. Now, if you think that the bad news in Tesla is overdone, that Tesla went from 400 to 300. Remember, it went down to $100 just like a year and a half ago. What I would probably do is sell a put spread on Tesla. Here we are. I would sell the 160 put, then as a stop loss, because I'm trying to make trades for smaller accounts. If it was me, I would just sell the 160 put naked and deal with it if Tesla goes down. But for you guys that are playing at home with smaller accounts, you could buy the 150 put to create a short put spread, which you would collect $3.10 with a 63 probability of profit, 63% probability of profit, and 74% probability of making 50% of your money. And this is a solid trade. Remember, none of these trades are recommendations or suggestions. These are just stuff that I would do, Uncle Tony would do, to play this weird, incredibly weird market that we're in right now. So Tesla is a weird stock right now. Tesla is part of the weird neighborhood, and these are very two solid trades I would definitely do in Tesla. If you think Tesla is going to stay where it is, I would do the iron condor, do the put spread and do the call spread simultaneously, and you can do an iron condor. I'm going to point out three very weird things that have happened lately, three very, very strange stock reactions. And if the consumer was so strong, why are these stocks plummeting? Why are these stocks having a rough time? First, let's take a look at Lululemon. Lululemon, which is, of course, everybody knows it's Lululemon. And look at this. They reported bad earnings. Look how the stock just plummeted. Lululemon went down the tubes. And if things were so strong, Lululemon should not have crashed that hard. Now let's take a look at DRI. Darden restaurants. Darden runs a lot of the restaurants that we love to go to. Darden restaurants. There's a lot of restaurants that I enjoy, that you probably enjoy too, that are owned by Darden restaurants. And look at what happened. Darden owns, Longhorn Steakhouse, the Olive Garden, Bahama Breeze, the Capitol Grill, Eddie V's, Season 42, Cheddar. I mean, Darden owns a lot of restaurants. The China Coast, the Red Lobster. I mean, we've all been to a Darden restaurant. And look at this. If the consumer was strong in the, fast casual, in the high end, Darden got hit hard because why? Sales are down. Sales are down because the consumer is not doing that great. The consumer is not spending money in restaurants. And going out to a restaurant is very, very expensive right now. And Darden got hit. People are not spending. If the consumer was so strong, why is DRI going down? Also, food inflation is out of control. Food inflation in the US is absolutely craziness. So restaurants have to raise prices, and they make it very expensive for a normal family to go out and enjoy a nice meal. And lastly, I think a very, very well deserved house of pain for a company that I don't know how this company is still alive, how this company is allowed to exist, which is Boeing. Look at this. Boeing is just a mess. You have airplane doors coming open, uh, safety issues here, safety issues there, safety issues everywhere. And I think Boeing is allowed to exist because it's a very important defense company. They produce a lot of important things that's strategic to the U.S. And I think it's important to keep these type of companies alive, to keep providing us ways to protect ourselves. And but regarding their airplanes, I think Boeing has dropped the ball. Boeing has not acted, in my point of view, in the most transparent way. And I think big change is needed in Boeing. If you think the stock got hit uh, too much, it got hit unexpectedly, same as Darden, same as Lululemon. Let's take a look at what type of trades Uncle Tony would advise you to. Well, no, no, sorry, I would never advise you to do any trades, because these are all ideas. They're just uh, simulations. These are hypotheticals that Uncle Tony would do. So in Boeing, if you think that Boeing, hit rock bottom, once again, you can buy a long call vertical. I would buy the 175, 195 long call vertical, pay $11 for a maximum loss of $1,100, maximum profit of $832. You could also do a short put spread. You would sell the 180 put, buy the 175 put, collect $1.50, which is one third of the width of the strikes, and there you have it. Those are two bullish ways to play Boeing. Now for Lululemon. For Lululemon. Actually, I like to play pickleball on my Lululemon shorts. Lululemon got hit hard. Look at this. Lululemon, it was down $75. If you think Lululemon was overdone, what you could do is you could sell the 400 put, buy the 380 put, collect $7, which is $700 maximum profit, $1,300 maximum loss, and you could play Lulu on the upside. You could also buy a call spread, buy the 390, sell the 410, collect $10, and risk one to make one. So those are two ways to play Lulu if you think Lulu was overdone, and if you think people like me who like to wear the ABC pants, that like to play pickleball with Lululemon shorts. These are two trades that you could do. Of course, Lululemon now has more competition. It has brands like Viore, which is an amazing brand, like Alo or ALO. I don't know how to pronounce it. That's very popular now. Now, Travis Matthew is expanding into lifestyle very, very heavily, very strongly. So Lulu is not competing by itself anymore. Lulu has a lot of competition. And lastly, if you think people that like to eat like Uncle Tony uh, are going to keep going back to Darden restaurants. What I would do is, here we are. You see a very tight range. You could buy the 160, 170 long called vertical for $5.18, or you could sell the put spread. You could sell the 460, 455 put spread. The difference between buying a call spread and selling a put spread is, if you think the stock is going to bounce faster, then you do the call spread. If you think you need a little more room to be wrong, if you think the stock might go down a little bit more before it starts bouncing up, then you do the put spread. So these are very, very weird things that are happening right now in the stock market. The yen acting terribly, interest rates like TLT acting crazy. We have stocks that are crashing like Apple, like Tesla, like Darden, like Lululemon, like Boeing, but the indices are still up. They're still up big. The stock market doesn't want to go down. And remember, there's something called MGI, market generated information. Nobody's smarter than the market. Don't fight the market. Don't fight the Fed. If the market is acting that way, that means the market is right and you are wrong. Uncle Tony may be wrong. Yes. So sometimes I know our contrarian minds, we want to fight the trend. We want to fight the Fed. We want to fight logic. We want to fight reality. Maybe in the long run, reality will kick in. But what if it doesn't? We're here to make money. We're not here to be right. So if you want to be right, trade correctly, trade with the correct tasty trade fundamentals, follow Uncle Tony, and try to grow your pile. Try to make a little more money every single day. And most importantly, remember, you gotta risk it to get the biscuit, baby.